Michael wants 200, baby.
You ready to get back to the trading action?
You aim, you shoot, and make money.
It's going to be a great day. You guys know where you're at.
Oh, okay. That would probably help. Welcome, guys. Thank you so much for joining me. Apologies there. So this is part two of our gap trading masterclass. We talked last week about some really actionable setups about the 5 major types of gaps that you can trade. We're going to be getting a little more granular this week. We're going to be really diving into the actionable ways we can use these setups, how we frame them, how we trade them, all that good stuff. But hey, if you didn't catch last week's, I highly recommend you check it out. Lots of good stuff in there. But we are going to be going over a quick recap of what we talked about then. So no worries there. All right. Thank you, guys. I appreciate it. What would I do without y'all? I don't know. But thank you so much for joining. I really appreciate that. As I said while I was muted, I'm Steve Tileman here with Trade the Pool. And let's get into it here. So we have a lot to talk about. Let's first go over the recap here. So what did we talk about? We talked about why gap trading is so valuable to add to your tool set here. It allows measurable statistical edges over all gap types, but they're really nice because the trades frame themselves with the gaps that are opened up. So there are many types of those, and we'll talk about those, but in general, they're broken up into 2 categories. Gap fill plays, where they gap up and then you're expecting them to fill. And that's a quick trade, usually a couple days. And essentially it's not a super high gainer, but they're very reliable and they're always appearing every day in the market. So, you can scan for these in the morning. You can have a really nice kind of a set of base hits that you can take. So you got the gap fills, and then you got your the real home runs. And those are the gap continuation plays, whether they're earnings ones, news-based ones, or just technical breakouts and continuations. And those are where you can catch really nice risk rewards, and maybe you size a little smaller, but they get you really nice gains. So we'll talk about all that good stuff. Like I said, the risk reward parameters are very clear, and they're defined with clear entries and exits, which is always something you look for in a trade setup. They work in all market conditions, whether we're in a bull market, a bear market, the infamous crab market. So it's always relevant. Like I said, there's multiple opportunities every single day. I think statistically, there's about 5 to 15 of these gap setups every single day in the market. So there's always something to trade. You can always hone these skills, and it makes it really fun to practice, because when you have something that's repeatable multiple times a week, you can really gauge your own progress and how you're managing and taking these setups. So I thought it was a really good topic to cover. They're also scalable too. You can do this on small accounts and you can do this on large accounts, because when we're looking for these setups, primarily we're looking for stuff with good liquidity as well. So with good liquidity and a reliable setup comes something that you can do with a small account or a large account. So what are the main types of gaps? There are a lot of different ways you can break these down, but for me, I kind of think of them in 5 main categories. So like I said, you have the gap fills and the gap continuations. So gap fills are when the price returns to close the gap. Gap continuations are when the gap signals a strong move with a strong directional move. So it gaps up and then it wants to keep going. You have post-earnings gaps, which are a little more specialized versions of ideally the gap continuations. If a stock gaps up on very positive earnings, you would expect that trend to continue. You have a news gap trading, which is a little bit more volatile, but the same general premise. If the news is actually actionable and a really worthwhile news event, then you'll expect that trend to continue. And so those all fall under the gap continuation bracket. And then there's also intraday gap formations, which are a little more nitty gritty. And that's when you see gaps between the morning session and the afternoon session, or maybe the London session to the New York session. And price very often likes to fill those gaps before continuing on in its chosen direction. And that's essentially because on these high liquidity areas where a lot of shares are traded, like the London session or the New York Open session, you will have these high volume nodes that form, and those love getting retested and basically picking up buyers that said, "Hey, I would have bought that London level, but it ripped on me from there. So if it comes back to that high volume, I'll buy it again." So those are kind of how I would categorize the main types of gaps. So what we're going to be talking about today is how to manage these setups live. Well, not technically live; the market's closed, but we'll be going over recent examples and giving actual examples of how I would trade them and what I'd be looking for, how to manage those positions, all that good stuff. We're going to be talking about some tools, timing, and techniques that professionals use to really maximize their gains on these setups. We're going to be going over portfolio management a little bit too. So basically how to trade multiple gap setups at the same time and not get over leveraged, not be too heavy on one side of the bull bear spectrum, so to speak, and just protecting yourself in that regard. And then we're going to try to wrap it all up into a nice complete system integration where you can really start to build this as, if you're trading as a business, to make these reliable base hits and these reliable setups part of your repertoire, so you can just consistently be profitable. Which that's always the goal here, right? So that's what we're going to try to cover here today. All right, welcome guys. I see more people coming in the chat. Thank you so much for joining. You came in just the right time here. So let's talk about managing each gap setup here. So we've got a lot of different things to think about here, but in general, let me scroll down my notes here. In general, I'd say most traders, they kind of rush into gap fills at open, and that can be a little bit damaging, right? So we like to give a little bit of time after the gap up happens, where we can or gap down, or we can kind of gauge what type of gap this is. So entry confirmation signals are really key. You can wait for price rejection at the gap levels instead of just immediate entries. And we'll talk about this more in depth in just a second here when we bring up some examples. But in general, you don't want to just immediately hammer it the second price opens, because often there will be a small retest of the gap. And based on the reaction that you get in the gap, whether it's just a little dip in and then it shows strong buying power, whether it looks weak in the gap, these are all really important signs that we can help to color our opinion about which type of gap this is and therefore how to trade it. So when you're doing these gap fills, you are basically looking for that rejection at the gap level, right? So the gap fill that we're talking about here is we're expecting the gap up to come back and close. So instead of just saying, okay, it gapped up, let's send this short because it shouldn't be this high, we need to make sure that it's not a continuation gap, right? So we want to see a rejection of the gap level, of that level that it opened of, if that makes sense. So when you're managing your stops on these gap fill setups, you want to put your stop beyond the gap extreme and with a little bit of a volatility buffer too. And that's where the art comes in. It's not an exact science, but some tools you can really help to use to gauge this volatility buffer are things like ATRs. I think ATR is probably the number one thing I'd recommend, and that's the average true range. So that'll give you the average move of a stock on a given day, based on its price history. And using that, you can help kind of gauge like, okay, because the stock on average moves this amount and we already gapped up this much, I wouldn't expect it to exceed this, X level. So that's how I would kind of use to quantify that margin for volatility there. And then as the gap fills, you trail your stops, because there are setups where the gap fills and then continues going. It does happen. So when you get those, you want to protect yourself and protect your profits, of the gap fill. But you also want to leave some on the table in case it is a reversal pattern where it gaps up, fills the gap, and then continues downwards. So when you're doing this, I think it's important to have a profit-taking strategy. I think that's important for all setups. It should never be all or nothing unless you're just scalping. And even then, I love taking profits on the way up. It just allows you that cushion and that maneuverability where you can really, you can have the flexibility to not be stuck in your bias, not be stuck in a trade if it turns against you, and to, like I said, book consistent profits, because that's what we're all about here. We want to get that equity curve nice and steady, right? We want to be consistently making money because we're not gamblers. We're here to make money consistently and for the long run. And because of that, we gotta look for these base hits. And so what I do is I take a 75% fill as the first target. So basically saying, all right, I'm expecting it to fill. There are some setups where it won't quite fill all the way, and those can really squeeze shorts, right? Because essentially all the shorts are waiting for that complete gap fill. And if for whatever reason buyers step in before that, those shorts can have to close out, might have to close out rapidly and chase each other up and kind of squeeze the price. So we want to avoid that. We want to be able to say, okay, it came down, it almost hit our target. We're locking some in there. And then if it does get squeezed, okay, maybe we stop out for a small win. Maybe we even stop out for break even, but we're protecting ourselves, which is always number one, because all of these setups are about replicability and longevity. So we want something that if we run it 100 times, we will consistently make money. There's always outliers, but we don't care about those. That's just the name of the game, so to speak. So the 75% fill is my first target, and then the full fill is my second target, and then I'll leave runners for continuation on these plays. Yeah, DJ 2AM, good to see you here, brother. 75% fill is a good move. I agree, because and the reason for that is everything can be divided into a range, right? And if anybody caught my Fibonacci webinars, excuse me, getting over a cold here. You know that I'm really big about these kind of divisions of a range. So the 50% is huge, not technically a fib level, but if a gap comes halfway into the gap and then you see strong buyers coming in right at that 50% level, that might be a sign that you're looking for a gap continuation play. If it comes down to 75%, like I said, sometimes those are really good risk reward opportunities for a long, because those shorts can get squeezed. But in general, it's showing that area of the chart, that gap, is basically being attacked, and the defenders are not being able to hold the line, a little bit into the gap. They're maybe the 25%. That's another level to watch. They're not being able to hold the line at the 50% of the gap. And so that 75% is a nice in-between target where you're not targeting the full gap fill quite yet, but you're still allowing a nice gain. You're still allowing yourself some room to wiggle there. So yeah, I think it's a really good way to look at things just in general. It seems really simplistic, but hey, sometimes the simple stuff's all you need. So one other aspect that I don't see a lot of gap trading, webinars or any content like that talk about is the time management aspect of that. So we have the price management down, but for time, you generally want to see these gaps fill pretty quickly, because if the move's going to happen, you'd expect it to happen probably within 3 to 5 days. So if you're not getting the fill by then, it's probably time to pack it up and move on to the next setup. So often these gaps will fill very rapidly, often in 1 day, maybe 2, 3. Once you're getting past that, you're kind of stretching it and you kind of want to be on your toes. So that's the gap fill management setup. And let's go into an example here. Rocking the Mike and Ike style, the pink and white candles here to rep my trade the pool pride. So what do we got here? This is Apple. And so Apple had earnings and it tried to push up into earnings and then it gapped down. So it created this window here, this little liquidity pool, or liquidity, like lack of liquidity, essentially, the opposite of a liquidity pool. So this is our opportunity here. What we would do is we are expecting this gap down to fill right back to this level. And it's a little hard to see because of my window here, but this second line, see this intermediary one, that's actually where the bottom of the wick is. So whenever you have a gap, you kind of have 2 targets, right? Because there's the classic gap fill, which is essentially just retracing up to the wick so that there's no space on the tape that wasn't covered between today's price action, this candle, and the actual gap down. But then you also have the actual close of the candle. And I find these areas are very responsive too. So because of that, you kind of have 2 staggered targets. And I always like having multiple targets just because, hey, we're never right all the time. And it's nice to just say, okay, this is a area of interest. There's another area of interest. I'll take some off at the first, some off at the second. And you just kind of want to watch how the trade progresses at each of these key levels. So here's the setup. Gap down, our stop goes underneath the low of the day. So we're not just entering right at open, because then we'd kind of get dragged a little and it would be probably pretty scary. It'd be hard to define our risk, right? But seeing the price come down and then form this wick and close here, that provides an actionable gap. So you are essentially looking for this gap to fill first and then this gap next. And your stop is under the low of the day that formed the gap there. You see that? So if this is if it's a little hard to see my screen, or if you're a little unclear on anything, please just drop a comment. I'm more than happy to get into it a little bit here. I really appreciate the feedback, and I love that you guys are so active in the comments. So yeah, please keep that up. So yeah, we have the first target here, and as you can see, it tags one of these 2 days. It looks like both of these days. So we would take a partial there, and then we would be waiting to watch if this lower area here, see where this first wick formed, if that area of support is validated. So you can see 1, 2, 3, 4 days, it dipped into the wick of this first day here. And each day it showed that there were buyers here. So these are all hints that you can use to help inform your bias and say, okay, I think it's pretty good for a gap fill here. So, we got the partial, and now we're looking for the full up to the body close where that high volume is, because let's talk about a little bit why that's an important level. Because, some people will say, well, the pure gap is just to the wick, right? And that's true, but it's never 100% or nothing, right? We always got to think about where the volume is coming in on these charts. And if you guys have spent some time trading, you probably know that there's a lot of volume that comes in at close. So when you have the close up here, the close of the body candle on the daily, you're going to know that there's a big pool of liquidity there that would love to get retransacted. If you were long here at close and then it gapped down on you, then you're saying, okay, well, I hope it doesn't. Maybe you're saying, all right, if it goes under here, I'm out, but I think it'll come back and revisit this level. And so that'll be a very natural point for the market to try to gravitate to. Because of that, that's our next target for sure. But then remember what I said. For these gap fills, quite often, if they fill, they can continue. So we've taken 1/3 off here is what I usually do, 1/3 off here, and then we're letting 1/3 run, and we're just going to let that cook and cook and cook. And how you manage that last third is up to you. It depends on your trading system. What I like to do is I like to watch my key moving averages. This blue is the 9 EMA, and then the yellow here is the 21 EMA. And I find these are very, very actionable on the daily chart, but also on every chart. So they're always on my screen. I think they're super, super important to help gauge the strength of a move. So as you can see, it just powers up right out of here. And all of a sudden, we are cooking, right? So what I personally would do, I also like watching the swing highs. So me personally, I think I'd probably take the last third off on one of these wicks up here when it swept this high. And I'd say, hey, great trade. What is that? That is about, let's say we enter, let's give it some room and say we enter at 230. And that's still a really nice move to 248 in about 2 weeks, let's call it. So, I mean, you can't scoff at that. Those are good gains there. Welcome, Tyler. Good to see you, man. Yeah, wild day. We can talk about it a little in the Q&A. There's a lot of fun stuff happening. So here's our example for a gap fill. Let's move on to the next kind of setup here. So now let's talk about gap continuations and how to manage those. So I think the first thing that's really important is that gap continuations, they require momentum confirmation, right? And so volume, it's got to expand and the price has to follow through. If you've heard my other webinars, I'm all about volume confirmation. I'm a big volume trader here. So because of that, I'm looking for that volume confirmation, that volume expansion to basically align with the price. So we want to see the price moving continuation as a continuation pattern, and we want to see the volume confirm that. So the entry timing is pretty key. I would say the first pullback after confirmation is a lot better to enter than just buying the gap at open. In the same way with the gap fills, we're looking for the gap level to reject. In this one, we're looking for the gap level to reclaim. See the difference there? So it's a really key level to watch whenever you're scanning the market for these gap setups. It's super key to mark that gap level. So then you can know that's kind of a big line in the sand. And if it rejects that, if it's looking weak, if the pushes up aren't confirmed by volume, you can look for the gap fill. But otherwise, you're looking for this setup, the continuation. So we got our entry. Where do we put our stops? Ideally, you're putting it at the gap level, because if momentum fails, after it's reclaimed that gap level, you're essentially saying, I don't think it's going to fill, right? I think it's going to keep going. And when it dips into that gap, it should be very strong support. So depending on your conviction and depending on the strength of the move, you have a few different options here. You can put it right at the gap once it reclaims and gives you some room. I like to put it on the swing low, like the first kind of dip into the gap before it then reclaims and pushes higher, because then it's giving you a little more room. You can basically frame it like this. Okay, we tested the gap the first time and it showed that there are buyers there. If we test the gap a second time, I would infer based on the strength of this that the buyers will be more willing to step in faster, and therefore the stop under the first swing will hold. It doesn't always work, nothing always works, and this is where it kind of helps to gauge the strength of a gap. And we talked about that last week, where there are kind of different criteria for different gap sizes. If you have a really strong gap, these gap levels are more likely to hold on the first or second try and not dip in too deep into that gap. If it's maybe a smaller gap, then maybe you should be thinking, okay, maybe it'll dip in a little deeper the second time to sweep out the stops that I just mentioned, where I would probably put mine on a strong gap up setup. So there is some room for discretion here. There's room for analysis and personal opinion here. It's not I always say trading is it's more like cooking than baking. It's more of an art than a science. We are all about the statistical edges, but it's about what we do with those statistical edges that we're given. So that's what I'd say for stops, because if the momentum fails, the gap will fill quickly. So you don't want to have your stop too deep. What you could also do is you could say, hey, I really believe in this. Maybe I'm taking a smaller position to allow a wider stop. And then what you could do is you can put the stop under the candle that leads to the gap, right? So you could say, hey, maybe they are going to close the gap, and I don't want to be stopped out right at the gap close, but I do want to essentially continue to be in this trade. So then you could put the stop under there. I wouldn't really recommend that for most setups. I think it's better to be a little more strict and diligent, but I'm just giving you some options here because there are options about how to trade these setups. So in terms of profit management, I really like once we've seen the confirmation, we've dipped into the gap, we're pushing up, I like to trail my stops under those moving averages that I talked about. The 20 period, I use a 21, same thing. The 20 period is a really good intermediary moving average. And I'll diverge just a second from the lesson plan to tell you why I love the 20 so much. So you guys trade with Bollinger Bands, anything like that, anything kind of like linear regression bands, anything like that. If you do, you'll note that the midline of those Bollinger Bands is always the 20 EMA. So this is a very, very watched level on an institutional level, on an algorithmic level. A lot of quantitative systems are built around this. So it's kind of equilibrium, in the same way that we're always watching that 50 on the any range, the 50%, the equilibrium, the halfway point. It's the same thing with a moving average here on a daily chart or any other chart. If it's above that, it's generally bullish. If it's below that, it's kind of lost momentum and it needs to retest at a lower level. So because of that, if we're playing a momentum setup like this, I think it's a really good indicator to say, hey, as long as we're closing over this on a daily chart, I'm going to let it rock, But if we start losing that, that's a sign that the momentum is failing. And then you have to be worried about a potential gap and crap, right? Nobody likes those, but they do happen sometimes. So we got that cooking here. All right. So yeah, that's gap continuation. Let's talk about some actionable stuff here. So we got NVIDIA here. This is a little bit back when they were just right before they started, call it topping, call it distributing, call it basing again up here. But on that crazy parabolic move, you had some wild earnings gaps and some wild gap continuations. So I know this is a little hectic, a little messy, but I'll break it down for you here. So first off, where's our gap? Our gap is from the close here to the open here. Nice big gap. So this is one of those gaps that really interests me because it's showing that the market was caught flat-footed. The market did not expect the results to be as good as they were, and they were real fundamental bullish results. And they really did augment the bull case, and really gave it a lot of juice. So because of that, I'm going into this trade thinking, okay, there's a lot of strength here. This is a powder keg. It is in price discovery. It is just ripping. And I don't want to lose money and not, lose gains just because I'm playing conservatively. I want the chart to prove to me that it's not going to keep expanding higher and keep discovering a higher price and negotiating that fair price with the market. So we've got the big gap here. And what happens? We open, we dip a little bit in. So remember, we're not buying right at open because then we're red a little bit and we got to sit here going, oh man, did I buy the top? Is it going to go all the way back down and fill? Where do I put my stop? What do I do? All of these contingencies that you have to consider if you don't wait for the confirmation. So what I would recommend is It comes back a little. Remember, these are daily candles. And then when it breaks back above that gap open level, remember, super key level there, that's when I'm in. That's what I'm looking for. A nice volume pop back up through there, nice increase in volume along with a couple big candles, that kind of thing to kind of give us a look that we're looking in the right direction here for a gap continuation play. So we've got our entry framed. We've got that set up. What do we do with it? What do we do with it? So the first thing is you measure the range of the base that it broke from. Pardon me. All right, chest cold. Sorry for the congestion here. Thanks for bearing with me. If you can stand this, then you've got the patience to be a good trader. So we're gonna measure our base here, and just when I'm talking about base, so price was going up, then it came down, and that's our base, right? That's the range in which we are breaking out from. So we measure the top right here, and the bottom right here. I probably should have drawn it at the bottom of the wick, but close enough for government work. And so what are we looking for? We're looking for fib extensions of that base. If you're a student of Bulkowski, and I did a webinar on that, great stuff. He's pretty cut and dry. He's just always looking for those double of the bases, right? So that 2 extension. For me, I like to have a little more nuance, and I'm a little bit of a skittish trader too, I like to lock things in as they come to me, and I like to, take the money and not necessarily run, but allow myself enough of a margin where I can really let the runners really cook in a way that I feel safe holding, in a way that I wouldn't if I was holding the whole position. So because of that, I really like the 1.68 fib. I also do have the 1.27 on here, but that's basically the fib that you would look for it to tag and then reject if the move isn't real. So we think this move is real. So my target is that 1.68. And as you can see, that hits very quickly within 2 days. Boom, you already locked in nice profit. Great. So what do we do next? So our next target up is that 2. And, when it's this explosive, you can hold for that 2. That's totally valid. I probably should have put another line for take profit there because me personally, I would do that. But in this setup, it appears that I only marked the 2. So I guess I was feeling ambitious when looking at this chart in retrospect. I wonder why, right? So we have our next take profit at 2. As you can see, it does a little bit of flagging, but it's totally fine. Why are we fine holding it here? Because there's nothing showing us that the gap continuation isn't working, right? So we don't even have to think about this 20 EMA. This 9 EMA is what we're watching for these real strong moves. That's where we would first want to see negotiated and kind of tested first. And you would expect on a gap continuation move like this, with this much power, that the first test of the key moving average, a rising support like this, would be met bullishly, right? So it's so strong, we don't even get there. So yeah, it's a little bit red. Who cares? Who cares? We've got our entry. We've protected our entry. Our stop is just right there. And we have framed this trade that if we run it 100 times, we will make money most of those times. If this is one of those rare times we don't, so be it. That's the game we're playing. But right now, flagging down, totally fine. And then we see price catch and just surge up again. So this is like just real big confirmation of our thesis, right? And this should feel great. It means we're doing the right thing, our eyes are in the right place, and we're getting paid for it. So price surges up, we take more profit here. And then what are we doing? We are just watching and waiting, and boom, big crazy gap up. And when you have a candle like this, that's when you should consider, being a little bit worried, because, that's a big kind of, you would call that a kicker, where it opens high and closes low. That's a sign that there was some big seller there waiting for that price. They weren't looking to sell here. They weren't looking to sell here, but up here they stepped in. So it's just something to keep note. And as you can see, looking forward, that is roughly the high. That is a level that has been defended. But just because there's a seller stepping in here doesn't mean the trade's over, right? What we want to watch are those trailing moving averages, right? We want to see those hold. They want to see those hold. DJ, you're too kind. But yeah, absolutely. If anybody would like to hit the like and show support, that would mean a lot. But let's stay focused here, boys. We've got the 9 EMA here. That's our level. We tag it, and what did I say? On a move this strong, we are looking for there to be buyers waiting there. Because if you weren't a savvy investor like us buying the gap up, then you're waiting for an entry. You were waiting here and you didn't get it. That's a sign of strength, But this is your first chance to buy it and manage your risk off the 9 EMA. And lo and behold, you get a nice pop already just off of that. So again, we're watching this 9 and it holds, and it pushes higher and it's unable to sweep this top. But here's how I frame this. So when you have a big candle like this with a big top wick, this shows that there are sellers, especially up in this top wick where price tried to push up, and that's where the sellers came in, and then sellers kind of dogpiled on that. Then they stepped out. But this wick area, if you stretch it out, that'll form like a zone of resistance. And if you think we're going to keep squeezing, remember, we've already had a crazy move here. So we're looking to book profits and wait for it to reset up again and move on to the next trade. We're not trying to overstay our welcome, but we also need the trade to prove us wrong because we're in it. So for me personally, with this zone that has been kind of clearly defined here with this wick, once we renegotiate that and show that it's not like a crazy, insane continuation volume pattern, like for example here, I mean, just to close, you have the wick like I'm talking about. See up here, there's the wick that forms a zone. Down here, there's a wick that forms a zone. So when this closes right at the high there, I'm ready to go. I'm chilling. I'm not worried. When we get this wick, I'd probably be selling some up here, and I'd be down to a real small runner, if any, at this position. Probably I'd book the trade. But if you want to let the trade fully play out, that's totally valid. You know, a lot of times you will be rewarded for that. If that's your style, then what you do is you don't have to trim here, but you're waiting for, you can define your own risk. There's a few ways to kind of gauge a loss of momentum. The first sign is right here where we lose that 9 moving average. So that's pretty valid, right? That's probably a sign that the major move is over. So you could stop out here and still very nice gain there. And if not, then you stop out on a close under this 20 moving average, because that's the major kind of momentum indicator, where if you're under that, you are not overtly bullish on the time frame that you're watching, right? It probably needs time to consolidate, time to heal, time to do its thing, you know, wiggle out and discover a fair price between buyers and sellers. So if you just strictly traded the system, you know, that I'm talking about here with a loss of the 20, then you do take a little haircut just because it closes at the low here and you are waiting for that close. So even then though, that is a 14% gain in maybe a month. And that's nothing to scoff at there. Those are real gains. So that is like the worst case of this trade playing out well, right? And the best case is that you did some of the things that I said. You took some up off here. You were locking in profits on the way up, so you're not even worried. And you know, like I said, these are very replicable. So that's how I'd handle this one. I think it's a fun setup to look at there. So moving on. The breakaway gap. And you'll notice this is pretty similar to the earnings gap that we just talked about, because often earnings gaps are breakaway gaps, those continuation moves. So these are, let's talk about a few more things here just to kind of flesh out the idea. So like I said, the pattern confirmation is super key, and you want to see that break with be from considerate significant consolidation. You know, essentially you want to have it have a constructive base that it's pushing out of, and the wider the base, the further the move will be. Just a matter of physics, right? Like the more you coil a spring, the stronger the energy will be when it's released. So that's basically what we're working off here. You know, all of this stuff, it's kind of just physics in a way. You know, it's kind of just I don't want to say common sense because there's nuances, but once you kind of internalize these concepts, it'll be really helpful for your trading setup. Oh, I see VSync mentioning hood there. Yeah, we talked about that last week in the newsletter, and it's doing real well. We'll try to touch on that too. And I saw Lulu mentioned as well. Those are both worth watching for sure. We'll take a peek at those later. So basically the same thing as the earnings gaps. Essentially, you want a little bit smaller sizing due to the binary nature of these trades. It either works really big or it just crashes and burns, and you get one of those gap and craps. So until we see clarity in the charts, we just want to protect ourselves, right? So we size a little smaller on these. Maybe we size a little larger on the on the gap fills, because gap fills have about, I think 75%, 80% chance of filling. They just love filling. So, you know, that's very high probability. You can size up and expect, okay, if I'm wrong, it's the 1 out of 5, and, you know, the other ones will make up for it. For these, the hit rate's going to be lower. So you just want to respect that, you know, respect the statistics, protect yourself in that regard. For these, I also recommend tight stops, because like I said, if it fails, it will fail hard. and you just want to protect yourself. And we do that with tight stops and small sizing. So in terms of target setting, we want to use the consolidation range, like I mentioned, to project minimum targets. So I know this is kind of rehashing, but hey, heck, why not? We get another example out of it. So this is hymns. It's a crazy move, crazy move. It hurts me a little because I missed this move and I was looking for it, but I just, so this is a good example because we can talk about what I should have done and what I didn't do. I was watching it in here and I missed my buy off of here. And I was watching it here like, man, it looks good, but I don't want to be wrong. You know, that's really what it came down to. And then we got the gap up and I said, I can't look. I can't look anymore. Sure wish I kept looking, huh? So what I should have done is played that gap up. So essentially, there's a few things to watch here. We get the gap up, and this one is a bit sloppy. You see, it does retrace a decent amount. So remember, we're not entering right on the gap up because it's just not very reliable. Even with these huge power movers, sometimes with the biggest movers, because of that increased volatility, you'll also see a significant pushback. Not always, but that's where it's important to kind of have market awareness, where if you know hymns, it's a high flyer, it's a momentum stock. When it cooks, it really cooks. When it sells, it really sells. I mean, look at this side of the base here. Straight parabolic and then just to the depths of Hades, right? So because of that, you get some shake and bake, right? You get the gap up and it does close over this key 50 moving average. But what are we really seeing? We're seeing open high, close low. It's a little bit of a worry, even though there's a bottom wick. And so that forms our gap, right? And so then we want to see, what does price do in the gap? So it gaps down a little overnight and it pushes down lower. Not sure, but it looks like it barely breaches the 50% line of this gap. And so remember, when you're under equilibrium, what are we looking for? We're looking for that price action that's like a beach ball underwater, right? We want to see it just pop back up and use every opportunity to really, to prove its strength, essentially, in that gap, in that area of low liquidity. So we do get the nice hammer candle, the nice big bottom wick and small body candle. So that to me is showing accumulation, that buyers are soaking this gap up. They're saying, okay, I don't even think it's going to fill. I think it's going to rip on out of here. So that's a positive sign, but we're still not ready to enter yet. Not me personally. For the higher probability setups, I really like entering when it reclaims the gap level there. So say we got in right there on the reclaim. Pardon me one sec. All right, there we go. So we get in on this gap reclaim and then boom, it's just off to the races, right? So what are we doing? First off, we're measuring the base that it broke from. So I was a little conservative in the base here. There are other ways you could possibly frame this, but for me, the base was basically just this little area. Oh, I'm sorry. I was going to say, I wouldn't have done this before. Yeah, this makes more sense. So this is the base for me, right? Swung up, came down, retesting here. So this to me is kind of the base. And what I would say is you mark that out and then you look for extensions. So you have the 1.6 here. That's a take profit level. You have the 2. That's a take profit level. You also have the 2.6. And then just to kind of throw something else at you, you should also be looking at, if it's a setup like this with a big left wall, you would kind of be expecting, hey, I think that we can sweep up here. I think that we can finish the pattern essentially and find a home for all the buyers that bought up here and let them get out, right? Price really loves doing that, especially on these big parabolic movers that show that they're not done yet. So when you're looking at this left wall, some things you can look for are things like gaps. We love gaps, right? That's what we're here for. So we have this gap right here, and we would say, hey, we've got momentum. There's a nice little target up here. We've already locked in some nice gains. I want to see what it does in this gap. And maybe you could be saying, hey, if it shows any weakness in here, that'll be where I get out. Maybe you're shooting for the full move up here, both totally valid. But I really like watching these. And let's see what we get. So we push up here, we take profit, very nice. You'll also notice that the bottom of this candle just kissed that 9 moving average, right? So big momentum play here. The first tap of the 9 moving average, we are expecting explosiveness off of that. And boom, we get it. Just beautiful tag and go here. Crazy expansion, easy profit take in what? 1, 2, 3, 4 days for, I didn't mark it, but what is that? 35 to 47 for the first trim. I mean, that's cash money right there, right? So yeah, these are all daily time frames here. All my charts here are dailies. I think that it's the best kind of representation for these because essentially when we are trading gaps, we're primarily trading gaps on the daily chart because they often happen with news overnight, with earnings, something like that. So yeah, all daily time frames here. Thanks for asking. Good to see you in here again, man. Appreciate you coming back. So we have our next extension here, the 2.61, and these are real aggressive. You know, you don't always get these. I kind of cherry picked here a little because this one was just in my mind as a great breakout continuation play. So this is where I would be probably getting just about all out, maybe holding a little bit of a runner. But, you know, I mean, this is such an explosive move in such a short amount of time that you can't expect it to go on forever, right? So another take profit there. Realistically, I'd be out one third out completely. But let's say it was a quarter, and we left a runner. Let's see what happens. So we see some mixed tape here, some back and forth. So it's not the straight up surging. It's not just one directional tape. Sellers are trying to step in. Why are they trying to step in? Well, we always look left, right? What happened here? Big parabolic move, spike up, sellers came in. Big spike up, smashing those sellers, but they reshorted, right? And you got the overnight move, and then they just held that momentum all the way down. So because of that, we're looking at this area as a sign of, or as an area of resistance that needs to negotiate. So it makes complete sense that when we revisit it, there will be mixed tape there, right? So we get the back and forth. What are we watching in this consolidation? Well, first off, we're watching our rising supports. This 9 moving average held like a charm. Can't be mad at this candle here. It's pretty natural, right? The first major resistance was respected. The second major test of the support respected as well. That's a good sign. And as you can see, buyers ran it up again. Where did they take it? Remember how we talked about those top wicks forming basically a zone of resistance? We see it again here. We get the top wick. It trades back into this. And I'll be honest, this is a little bit tricky, right? Because this candle closes so strong, this big white candle here. But it does respect. And overnight, we do see a fade off of that level. So now we lose our 9. Now, here's where you can say, hey, we gapped under the 9. Kind of sketchy. How I would manage this is say, okay, now we're really close to the 20. The 20 caught up nicely. And as long as that holds, I think I'm still in. And probably I'm going to be watching for this gap to fill and thinking, hey, maybe that'll be the kind of wick back up to clear out any more people on the tape, participants on the tape, and kind of set up for the next move, which could very well be down, right? It would make sense. So that is an area where I would say, hey, okay, we come down. I'm still in with my runner because we held this, but I need to see it show some strength in here. So it comes up, and maybe on this doji, you're a little unsure, and maybe you take it off right there. It's totally fine. You'll be kicking yourself in the morning when it surges up here. And if you did hold, I'd say this is your take profit because, man, it's just a crazy explosive move after a crazy explosive move. One thing about topping patterns is they very often will double top, right? And the method or the mechanics behind that are you have the parabolic move, shorts come in, and then bulls say, hey, man, this is a good stock. I think we can keep running it here. And then bears have to basically confirm that, no, this is a valid level. You guys are getting too big for your britches. We got to cool this down. It's just not sustainable. And so that double part, that double top, that second push up, that's where you'll often see kind of the end of the initial parabolic move. All right. So that's what we're kind of working with here. And as you can see, big spike up again into this resistance zone. And hey, I'll be honest, if I was trading this and it was up here, it'd be hard to sell because then I'd be going, hey, we can go higher. But it's just important to practice discipline and just be cognizant of the fact that you are in a resistance zone. And if you listen to that, obviously super easy to say in hindsight, but these you'll see these very often, these types of setups where it'll do this kind of thing. So that zone was respected. And then I'd say probably, well, it's tough because it didn't close under. So I think I would still be in this trade to this day if I caught it like this, So just some food for thought there. I think this was a good example just because it's such a high flyer. And for these gap and goes, you really want to be targeting these high momentum names, stuff like the OKLOs, the SMRs, the HIMs, like I mentioned, Roblox, Hood, that kind of stuff. So these are some of the best trades to play these continuation moves. NVIDIA, another example that we just went over. John McClain mentions an exhaustion candle. Exactly. So that's what that looks like to me, right? I mean, it tried to just power on up, and that's a huge range for a candle. We're talking, what, let's call it 53 to 67 or something. That's crazy, right? So whenever you're going to move like that in a day and it can't stick the move, you got to be worried, right? You got to be thinking, hey, this has to digest a little bit more. Doesn't mean it's going to die, and I don't think HIMS is dying. I think it posted a good day today as well. Oh, is this today's chart? I can't even remember when I pulled this. Anyways, to me, what it looks like, here's a little free alpha. To me, it looks like we did the cup, and now we're starting to form out a handle for continuation higher. I'm a HIMS bull. What can I say? What can I say? So that's an example of the continuation move, the breakaway gap. So let's talk about earnings gap managements here. And we'll get into another NVIDIA example because, man, they just keep giving me such good examples on that chart. So I think the most important thing with earnings gap, as opposed to your traditional breakaway gap, like we saw with HIMS, is that you need to very quickly, pre-market essentially assess, is this gap valid? You got to analyze. And this is where I do think it's important to expand. If you're just a technical trader, it's really important to essentially, I'm sorry, I'm getting distracted by a window here. Let me move that just a little bit so I can see everything I need to. There we go. Okay. So it's important to basically gauge the move, not just from a technical perspective, but from a fundamental perspective. And I know it can be kind of overwhelming, especially if you're a pure technicals trader. Maybe you avoid some earnings gaps because of that. That's totally valid. But I think it's really good to help kind of dip your toes into fundamental analysis and basically get a feel for, looking back at previous examples, what constitutes a breakout earnings continuation gap move. And essentially what you're looking for is a double beat. You want to see a beat in earnings, and you want to see a revision up. You want to see all of the things that show that this company was undervalued and now the market is starting to catch on, right? Because you want that institutional inflows. You want Wall Street saying, hey, maybe this wasn't on my radar. Maybe I wasn't sure about it. Now I got the information that I need. And then you'll see, just like we talk about volume and price confirming each other, the fundamentals and the price action confirming each other. So once you get the fundamentals to kind of match what you're seeing in the chart, that's a sign for a lot of other cohorts of traders, institutional traders who trade off of the fundamentals, to say, hey, I'll join this party. Let's rock. So because of that, I think it's really important pre-market to take a look at that. And that's going to be your kind of your litmus test about whether you think this is going to be an earnings gap and go, or whether it's just going to be one of those kind of iffy reactions where it gets a little bit of a pop and then, fades and closes that gap. It needs to continue basing. So the second thing is, if you're trading options, it's super important that you're cognizant of IV crush, because essentially IV will rip probably like 60% on average, and then it will crush super hard. I don't have an exact metric. I think it's actually more like it rips like 30% and crushes 60%, something like that. So because of that, if you're in an options play, you want to exit between 2 and 3 days, right around there. Earlier if you get your move, right? Take the money if you're in options, honestly. And doing that will help avoid the theta decay, and it'll help avoid that options crush, or the vol crush. So because of that, you can see really big winners turn to losers fast if you don't manage them appropriately. And that's why I'd steer away from options if you are a new trader, and just in general, you got to really know what you're doing for earnings plays when it comes to options. That's why I love trading options on my Trade the Pool account. Honestly, it's just super easy to do. I have one of those swing accounts, so I can use all my buying power. Not that I would use all my buying power on any one play, but it gives me the options and the flexibility to do this kind of trade without having to worry about getting my vol crushed. Nobody likes getting their vol crushed. No. Tim is making a very good point that I should clear up. I'm not trading options in a Trade the Pool account. This is why I prefer the the pool account, because I'm just trading shares. And because of that, I avoid the Greeks. I avoid getting crushed on the volatility move, the IV crush. I avoid the theta crush. Thanks for pointing that out. I probably wasn't clear enough there. So yeah, there's the balance between fundamentals and technicals. So the balance, you got to balance the earnings quality with the gap size and kind of say, okay, does this fundamental change justify and validate this gap up? And so doing that will just help you kind of align yourself, like I said, with the immediate assessment and just help you kind of frame the trade and be ready to go when it's time to go. So the last thing I want to talk about for earnings gaps is it's okay if you miss it too. What you can do is you can look for sympathy plays. And essentially a sympathy play is when a stock will move following the leader of the basket. So for example, Zscaler had a smashing earnings. They gapped up big and closed at the high a day after the gap up. Amazing move. If you were trading with me, you were in it, just saying. But if you weren't, you had the opportunity to get into like CRWD, what is it? Crowd share, crowdsource, whatever. Crowdflare. I don't know. You can tell I'm a technical trader. The point was it was setting up. It's a good company and it was leading, or it was going to follow that leading stock's move. So doing this, you can set yourself up for some really high probability plays. And maybe they won't be the huge winners as if you were in the best thing at the right time, but you have a lot less risk, right? So that's a really good way to kind of play these if you're not confident in your fundamental analysis. Just putting it on your radar there, giving you some more options. So let's talk about another NVIDIA setup here. And I know, again, just confetti puke here, a lot of lines, but there's a lot to talk about. So ignore these ones down here because that was the previous setup that we talked about, this gap up here. Now we're looking at a continuation move, an earnings continuation move. So as you can see, earnings, the E right here, this was the gap. This was the gap. So what do we have? Let's talk about what we got on our screen here. We've got the gap itself. And then when you have this power gap, for me, when I was looking at this, I said, hey, you got some areas here. If we draw this over, kind of aligns with the base. It wouldn't be super surprising to me if we dipped into this a little bit deeper than the last example of NVIDIA, where it had kind of carved out a lower move into the earnings. I don't know if you remember that chart, but the chart essentially was flagging and then it dipped into earnings, and then on earnings, it shot out of there. So for this, it was tighter. It was a little bit more aggressively bullish. So maybe I'm wrong. Maybe I should be inclined. And the chart does show that it actually would test the gap even less. It actually didn't test the gap at all, which is crazy. So this is pretty rare, I would say, but it is a real sign of strength. But for me, I said I'll put the stop right in the middle here because why am I willing to risk a bigger stop? Well, it's a bigger base now too. This whole thing has just been flagging. When you get a base this size, you'll often get a move. This is not scientific, but what I have noticed is when you have a base this size, you will often get a move that's roughly that size. You can kind of see that right angle there. Not scientific. I gotta run the numbers on this, but hey, in general, the bigger the base, the bigger the space. So John McClain, CrowdStrike, thank you. That was driving me crazy in the back of my head. Okay, yeah, so you got the big base, you're looking for a big move, you allow yourself a little bit more room on the stop. It's a big gap, but these big gaps off a big base, that's such a good sign. That's really what you want to see. And again, more just confirmation between the size of the base, the size of the gap, the size of the earnings news. It was all just a slam dunk, and the market wanted to reward it. So you saw it straight out of the gate, and this would have been tough. I'm not going to lie. This would be pretty tough to just say, hey, we're going right from the gate. So maybe you miss it. Maybe you wait till the day closes and you say, hey, okay, I wasn't confident enough to just buy it essentially at open because it really didn't give you a look back into the gap to prove itself. But it not giving you that chance to, or giving itself a chance to prove itself, is kind of proof in and of itself. Does that make sense? Because it didn't test the gap, that's a sign of strength, right? So because of that, I'd probably say this is my hindsight 2020 entry right at open. But in reality, I probably would have entered a close here. So still plenty of room on that, and essentially you were saying, okay, I wouldn't expect it to dip much into the gap at all, if at all. But if it does, I'll give it a little room. If I enter here, I might just put it at the gap here. If it closes into the gap at all, I'm out. And I think that's totally valid. So then what are we doing? How are we gauging this? How are we framing this trade? Well, remember, we're going to measure the base. So these highs here to the low here, basically the consolidation range before the breakout. And we are going to project that up. So when we project it up here, what are we looking for? We're looking for that 1.62 fib. We're looking for the 2, and we're looking for the 2.61. So as you can see, this one worked real well. You got the initial just surge up and it never really looked back. And then you have another power gap, as I'd call it, like a continuation of a continuation gap. And hey, that's just showing that the market is hungry. As long as this gap holds, you're ready to party. So maybe at this point, I move my stop up to, hey, if it closes under this gap, I'm out, just locking in a small win and letting it settle. Because if it fills this one and then closes under it, it's a good chance it'll try to fill this one too. And you don't want to get caught in a reversal. So because of that, you're watching this gap and you're also watching our moving averages. As price surges up here, these are going to steeply move up with it. And you're going to essentially have a really nice way to cap your risk just built into the charts here. It's a really, really handy thing to watch. So we have our targets. We enter gap. We instantly hit this. It's not a huge target, but hey, I would lock in a little bit there, just give myself that cushion that we're talking about. I'd feel pretty good about that cushion on this day, but hey, we still close basically at the high of the gap. So what did that tell us? We opened a new gap. Basically, this gap is protected until this gap fails. And now we're testing this. We wick in and we catch right at the top of it. And we couldn't even test the 9. So these are all signs of real strength. So because of that, we are going to essentially just stick with the trade. It's working. And look at this, more expansion gaps. The market can't get enough of this thing. If you guys were trading, when was this? Like last year, I guess. Excuse me, you know just how explosive this move was. And everybody and their mom was saying, get me in. Or they were saying, you can't keep going because they missed it, But if you took this setup, you're not missing much at all. So we're still in, we're still riding it. What are we waiting for? This 2. We come up, surge above it. Hey, beautiful. We lock it in and then we keep waiting with our runners. What are we waiting for? Either the big extension goal or we're waiting for a loss of this 20 or these shorter term moving averages. And remember, this is where the art comes in. I'm not going to say stop out the second you lose the 9, stop out the second you lose the 20. That's really dependent on your trading style and also on the velocity of the move, right? So we were kind of talking about with the Hims chart, and it's pretty similar here. So we get this big power surge. And so here's how I would look at it up here. I would lock in more. Realistically, I'd probably be out of the trade. Maybe I'd leave maybe I'd do like 2/3 or 1/3. Then I'm up here going, oh, it's so strong. I don't want to get out completely. I'll take off 1/6 and I still have 1/6 or whatever, And what I'd be looking for is saying, okay, we are stretched here. Just mathematically, we are stretched. Even the best names in the world, they got to cool down. It's just what goes up must come down at least a little bit for a little while, right? So because of that, we're looking for signs of weakness up here. We gap up again. How many gaps is this? Let's count. 1, 2, 3, 4, 5, 6, 7 gaps. That's insane, right? You got to think eventually it's got to cool down a little bit. We're not calling tops here. That's not what we do, but we are managing risks at key locations. So we take some off at the 2.61 and we look for signs of weakness. Nothing here. This seems fine. This is a nice stick. This is a kicker candle. This should worry you. Not even worry because you're deep in profit. This should be a sign that maybe you're overstaying your welcome. So because of that, on this close, I'm not saying get out, but I would be saying head on a swivel. If it shows weakness from here, it's probably going to see some continuation down. So I would say either you get out at close when you see this candle post bearish, or you say, okay, I'm going to give it some room. I think this still has legs, but it's got to prove itself on these moving averages. This day, gaps down, fills the gap up, sweeps lower too. It probably swept lower first and then filled the gap up and closed right here. So it's kind of an ambiguous candle at a key level. There were buyers here. There was a logical reason to send it back up here. There was a logical reason to test below and test here. It all makes sense, right? Pardon me. Oh, I'm going to blow my nose real quick. Don't get sick, guys. It's no fun. All right, where were we? We are watching these moving averages. So this one makes sense. This is a little scary here. We knifed through here, and it's probably showing that there are sellers up here. There are sellers in this range. So totally valid if you got stopped out here. That's why I put this here. If you're just going purely by the book, by the numbers, this is when you'd get stopped out. And what do we have? We have about a 16% move again on this name. It's such a reliable, just, man, if you're in these, you can wait for them to rebase and just keep them on your list, and you'll often get a second leg. So really good to have on your radar there. So yeah, worst case, you get 16% or so. Best case is, some of these trims are a good 20, 25% if you're getting out up here. So just stuff to consider. And then you're watching, okay, it's basing on these moving averages. And then when it gaps up again into this body here, so this is kind of like, this is where the seller stepped in. So that's where we're watching again. This second red candle here, I'd just be out. I'd just say, hey, this looks like a double top. We've already made the move. I don't need to wait for confirmation. And, it kind of played with you, right? Played with you here, holding the 9, played with you here, holding the 20, and then just gapped down, backtest failed, and then it started sliding. So I think that's a good example to cover a lot of the different contingencies that you can see there. So let's talk about the psychology of gap trading just a little bit here. I think it's really important to always think about the psychology of any setup you're trading, because it's just so key. The whole thing about charts is they're essentially a visualization of the group's psychology, their thoughts and feelings on any given chart, right? So it's really key to essentially try to get in their minds and see why it's moving, how it's moving, because understanding that will help you predict what it's going to do. And that's the game here, right? Alrighty. So in terms of market maker behavior, they provide the gap fill liquidity. And they like to do this because, remember, market makers get paid off of the number of transactions, not on whether a price goes up or down, because they are constantly on both sides of a trade. They're buying low in a range, they're selling high in a range. They're basically providing the liquidity to the other side of the active traders. Because of that, you really want to watch these key levels. When the gaps fill, what does price do? Because just getting the gap fill is not confirmation of anything other than, well, market wanted it to go there because there were a lot of orders to fill there, and it really can be that simple. So because of that, really important to keep that in mind. It's also important to, sorry, I got distracted there just for a sec. Oh, I see why. Tim is reminding me that we have a very special event coming up that you'll hear about at the end of here. So stick around. We're gonna have some fun and trade the pool community. But getting back on track here, retail panic patterns are really important to watch for too. So these emotional gap patterns, they can create continuation opportunities where a stock can gap up and it's just such a big move that people are like, oh, I'm gonna fade this. There's so many traders who fade gap ups, and I'm sure some of them make good money, but I need to see the characteristics that we were talking about in the gap fill section to take those setups. A lot of people just hammer it open, right? And the initial push down that they provide, that knee-jerk reactive push down that does not align with the fundamental change in the stock, that can provide a really good opportunity to buy that pullback that they create and push the market up and get that continuation pattern. So I think that is a really, really important thing that a lot of people don't talk about. So I just wanted to put that on your radar as well. And we can also talk a little bit about institutional footprints. So that would be essentially using big volume patterns to kind of help reveal the positioning of these institutional investors. So by that, I mean, when you see big volume sticks, either on the volume chart on the bottom of your screen or on your volume profile at a certain level, that can help you pinpoint just where institutional investors are positioning. And you can use these levels as essentially levels of resting support. So they're boosting it off of this key level, whatever it may be. If price drifts back down to that key level, if you're an investor, you're not hopping in and out of positions every 5 minutes, right? Sure, there's tons of different algorithms and stuff, but in general, the biggest resting volume, the volume that actually pushes these moves into continuation plays, they're people who, or they're institutions, I should say, that believe in the stock going significantly higher. They're not here for 5%. They're here probably for 10 to 20 to 30 to 40%, that kind of thing, right? So because of that, we are looking for just a casual drift down off of their buys. They buy here, it surges up because everybody's like, whoa, look at that volume. When it comes back to that level, we can use that as support to risk off of, we can say, hey, maybe we missed the pop, but we're looking to basically ride the coattails of these institutions. And this is where I think retail traders have such a big edge that really doesn't get talked about. You always hear about how the hedgies are out to get us, and Citadel is the boogeyman and all of that, yada yada, whatever. What they don't talk about, it's all this victim mentality stuff. What they don't talk about is that we can be nimble. We can rapidly reposition. We can see these big orders that they place on the books and trade around them. They can't do that to us. I don't care who you're listening to. If they're telling you Citadel's hunting your stop, nah, they're hunting these big stops, or these big stops are levels of an institutional interest, I should say, more specifically. Less hunting and more confirming that this is a level where institutions want to buy. If they step back out, well, that's more information for us. That's probably going to be a gap failure move. But if these levels that institutions bought at are supported, you can expect the move to try to continue. So the last thing is just your emotional management too. It's really important to have a pre-planned route and to execute that plan accordingly. And so that's why I've tried to really this week kind of take it out of the arbitrariness of the previous week and really ground it in reality and fundamental examples where you can see how I would manage it personally. And I'm not saying I'm the best trader. I'm definitely not. I'm probably not the best trader in this room, but that's okay because I'm decent at explaining my thought process. And that helps you guys outpace me, which I love to see. If I'm doing my job, the thing I'd like to see most is you all trade me under the table next week. So get to it, hit the books, practice, and come school me next week. So one of the last things I want to talk about is just some professional execution methods. Nothing too crazy, but just what in general, what you want to look for is you want to systematize things. Is that the right word? We're rolling with systematize. Essentially, institutions and professional traders, they are not really operating that much off of whims and emotions. Sure, it's always a factor. We can't iron that out completely, but in general, they're very regimented in their plans. So because of that, I think if you want to trade like an institution, I think it's really important to set up a routine. So for me, this is my rough routine. I get up a little bit early. We'll call it 5. Sometimes it's more like 6, but essentially, sorry, these are West Coast times too. Essentially, you want to get up a little bit before market opens and you want to scan around. You want to see what's going on. You want to try to categorize the gaps. You want to categorize the gaps and you want to kind of say, okay, I think these ones look like they can continue. I think these ones maybe look a little weak. Maybe when I'm waiting for the confirmation on my continuation ones, I'm taking some base hits on the gap fill ones. So by having these kind of baskets that you're sorting into pre-market, you're not stressed when the bell hits. You're already ready to go. And most importantly, I think that you will have limit orders at your key levels, whether it's the 25% or the 50% of the gap fill, whether it's a buy limit order when it comes back through with volume. Usually I'd recommend visual confirmation of the volume surge back through that gap opening level. But in general, you want to systematize things as much as possible and basically automate what you can and let your emotions have as little control as possible in these trading setups. So another thing you can do is essentially news catalyst assessment. So you can rate the news strength 1 to 10. I know it sounds arbitrary. It's like one of those charts at the doctor's office, like which face do you feel right now? How much pain are you in? It can seem arbitrary, but just having any kind of metric, whether it's, even if it's completely your own personal one, it really helps you gauge and sort these setups and say, well, there's 5 setups that gapped up that I think could continue, but the news for these 2 seems really, really robust and really valid and, like actually actionable. So maybe you just focus on those 2. And that's where the other thing I talked about a while ago that we mentioned is how to manage multiple gapping positions, because it's really easy to say, okay, well, maybe SPY is just really strong pre-market. And so all of these earnings catalysts, all these news result catalysts, they all seem to be just wanting to continue. Well, if you load up on too many of them, you could find yourself in for a shock if all of a sudden SPY changes its course, half an hour into the day or whatever. So I think it is important to not overcommit on these setups. Just take 1, maybe 2. And if you do take more, it's really important to practice discipline and have strict risk management. If you're taking the entries on the gap reclaim and you have a couple and you're not able to watch all of them, especially, I think it's really important to really tighten up those stops. And it's okay to get stopped out break even. because that's like you did nothing, which is probably what I'd recommend. So that's totally fine. What you don't want to do is have wide stops on 3 to 5 to 8 whatever positions, and then you go pet your cat or get a cup of water, and you come back and you're down a ton because you weren't being diligent about the potential risks, the potential tail risks. Yeah, you always got to think about what about that 5 to 10% chance that everything just goes to hell in a handbasket, right? You want to be able to protect yourself from those outliers, and you do that with the planning, not with being fast on your toes and saying, okay, now I got to make 10 decisions in 5 minutes, and that kind of stuff. You're setting yourself up for failure. What we're trying to do here is set yourself up for success. So I think those are really key, and it's also really key, like I mentioned, to touch base with the market and see, okay, is everything just ripping? What's the context of the market, right? And that's the next point here. So you want to check the VIX, the volatility index. You want to kind of gauge the fear and the willingness to buy in a given market. You want to check the sector rotation. Your heat maps are great for that. And that'll kind of give you a feeling of where the money is flowing. So ideally your stocks are, your earnings gap ups or your news catalyst gap ups, they are starting a movement, and all of the things in that sector are finding bids because the market is essentially preempting this being a real move, and they're wanting to get their foot in the door on the sympathy plays, which we also talked about. So that's super important. And also just always have an economic calendar readily available. I think there's a lot of good takeaways from this, but one really easy one to level you up is just bookmark an economic calendar and just make sure before you're trading on a day, especially if you're day trading, to know what events are coming. I think it's on Bloomberg. I'm not sure actually. I can drop a link for anybody who's interested, but there's a really good one. I think it's probably the top result if you search economic calendar, where it actually rates the impact of every event. And by doing this, you don't have to be a macro whiz kid, you don't have to be some high level quant. You can really easily say, okay, these are the events that are going to change the market. These are the kind of pivot points, the inflection points that I need to watch for. And using all of this, you can help kind of give yourself a cohesive view of what the market may do on a given day. And super important when you're trading these gap continuations or even gap fills, you want to know what the market in general wants to do. Also because I don't know if you know this, you can make money just trading the market too. So it's always good to know and kind of help inform your bias there. So what else do we got here? Opportunity rankings. So this is just kind of what I was talking about with rating the news. In the same way you're rating the news, you're kind of ranking the setups that you see on any given morning. Pardon me. That was a big one. Okay. If you create a priority list of like 3 to 5 gap trades that you really think are the best of the best, then you're really doing yourself a favor. And it doesn't really seem like it at the moment. It might feel like you're limiting your chances. But let me tell you, you do not need to take more than 5 trades a day. I don't know. If you need to hear this, I'm telling it to you. If this connects to you, then it's probably a sign. Overtrading is so easy to do. And I think it's just really important to remember that this is one of the very few jobs that people are so passionate about that they will wake up in the morning, make some money, and then proceed to say, hey, maybe I'll keep working and give it all back. Who would do that at Starbucks, right? It's like, okay, you could get off shift now and just walk away with your full money, or you could keep working and maybe I take it all back. Maybe you lose money, So I think it's really important to just be diligent and just practice an abundance mentality, just like in anything in life, right? You're not fighting for scraps, You are a king or a queen. You deserve the best. Treat yourself to the best setups. Don't worry about the rest. Every single day there will be more. We're teaching how to fish here at Trade the Pool. We're not worried about any one meal because we know we can just pop that rod back in the water and get another fish. So I think it's really important to just hone down on the best setups, and you'll really set yourself up for success. Even if it's a little bit of a rough learning curve where you're like, oh, I missed this and this and this because maybe I wasn't using the right metrics to make that list, but that'll improve over time. And what you'll be doing is you'll be protecting yourself from the downside of being in suboptimal setups, just straight up. So I think it's super important. All right, we got a comment here saying I take 2 to 3 max. Absolutely. I do my best trading when I'm in 1 to 2, maybe 3 active positions at a time. And if I'm in 3 active positions, you better believe I've got take profits and stops ready to go. So I could run off from the computer if I had to do something, and I wouldn't get skinned either way. I'd be protecting myself in that regard. So Super important, super important. Got another comment. AGT is a very good strategy. I'm actually not familiar with that acronym. There's so many. I'd love to hear a little more about that if you're still around. But yeah, thanks for the comments there. Let's keep it pushing here. We're almost done. So I just wanted to talk about a little bit about advanced order management. I think it's really important just in that kind of skill set of trying to emulate institutional trading. So I think limit orders are a really, really essential part. If you're just a slap ask market order guy, if it works for you, God bless you. But in general, I think it's probably better to try. I think I'd place probably 75 to 85% of my orders using limit orders. Because if I'm placing a limit order, one, I'm not worrying about the spread. I'm not going to have to chase a spread. And, that is a factor, especially on some of these more fun stocks that we trade, the smaller cap stuff. But in general, having these limit orders, it allows you to define your risk in advance. It allows you to not experience FOMO and not have to worry about, like, oh, am I just hitting this because it's a good 1 minute candle? Is that why I'm in? You're like, no, I planned this out. That came to my level. It did what I thought it would do. And now it's a valid setup. So that's super important. Stop order placement as well. That's another thing I absolutely love about Trade the Pool. You get OCO orders, which is one cancels other, which essentially means that you can, you don't have to worry about resting orders in the book that you placed. Basically you're saying, okay, if it goes up and hits my target, great, I'm out. If it comes down and hits my stop, that's okay, I'm out. And by doing that, you don't have to worry and micromanage quite as much. I'm not saying don't watch your trades, but I am saying have these safeguards in place and maybe allow for volatility buffers, X, Y, and Z, but that's a personal thing. But in general, it's just really important to have your risk defined. Super, super important to have your risk defined. Alrighty. Just making sure I'm not missing anything here in the comments. And remember, guys, I love feedback. I love questions. Hit me up. I always spend feels like I spend more time answering questions than I do on the webinars. And I love that. That's my favorite part. So absolutely hit me up if you guys have any questions, comments, anything. All right, we got gap theory works wonders in NASDAQ. Absolutely. Anything with high liquidity like that, gap theory is just boom, just money. It's a big part of my trading strategy. So definitely something to consider there. I'm totally with you. And what else do we got? We got some dynamic risk management system. We've got a few tools here that I think will be really helpful. So like I mentioned, ATR, the average true range for stop placement, is super useful because it's so much better than just having a one size fits all kind of stop, because let's be honest, every stock moves differently, right? And so by having a indicator that measures for you, that quantifies the size of a move, it really allows you to kind of open up your brain space to process the more artistic side of it, right? Like how you want to frame the trade, how you want to manage it, what your targets are. And, and just, it allows you that kind of latitude because, hey, if you're right, you get to manage the trade how you want. And if you're wrong, well, you have a statistically backed system to say, hey, I'm wrong. This is the level where it's proven to me. And yeah, that's definitely very helpful. All right, I love you all, but I'm dying here, so I'm going to get some water really quick. I will be right back, and please keep the questions coming because we got Q&A coming up pretty soon, and I would love to have a nice chunk of questions to talk to you guys about. So give me 30 seconds here. All right, all right. Thank you for your patience. Figured it was better to have my coughing fit off screen there. Okay, so we've talked about ATR a little bit. Talked about time-based exits as well. So there are different kind of max hold periods for each type of gap. We talked about it a little bit, but just in general, the rule of thumb is that you want to see gap fills happen pretty quickly. You want to see gap continuations happen probably a little more quickly because you want to really see that strength, right? You want to see the market essentially kind of show its hand and say, hey, we're going up, right? So just in general, kind of keep the time aspect in mind too, because there's one. I am a levels trader. I don't worry about time as much, but it is really important to kind of factor in. So keep an eye on that, and keep an eye on the correlation monitoring too. So that would be stuff like overexposure to a single sector. Maybe on your morning your checklist, you see a lot of things in one sector moving together and all presenting a similar gap up setup. I would recommend sticking to the best one, maybe two, but think about it. Why would you be in two assets that are so highly correlated when you could just be in the strongest one? If it goes sideways, you're just going to book more losses. If it works, just size up on the big one, right? So that's kind of how I would look at that. Always try to play the leader if it's giving you a good opportunity. And then the last thing is just, why did that say two? I should say four. Sorry about that. The portfolio heat map. So you just never want to exceed 20% of the total account risk across all gap positions. I think that's a really safe rule of thumb, especially for these trading accounts like Trade the Pool. That's the rule I use personally, and it's helped me out. So awesome. I think that we are just about ready to wrap this up. So we're going to talk a little bit about kind of integrating this all into one system, which honestly, I think we've laid good groundwork in here. So this will just be kind of bullet points, wrapping it up here, and then I'd love to get to your questions as well. So is this a duplicate screen? We already talked about this. We're moving on. So let's talk about the path to mastering these skills. So the first phase, I think, is really important to just identify them. So just what I'd love to see, guys, is if you want some homework, if you want homework from Professor Steve here, I'd love it if you kept track this next trading week and just every morning pre-market when you're doing your rundowns, try to keep in mind what we're talking about here. Try to find those gap setups, try to sort them into gap fills or gap continuations, and then keep track on them. And I'd love to hear next week about how that goes. I bet as the week goes on, you'll hone that skill and you'll be able to identify them better in just a week. It's one of those things where once you keep an eye out for it, it'll click, and then you'll really you'll develop the skill quite fast. It's something that I believe all of you guys can get a handle on pretty quick here. So we've got support and resistance at the gap levels. This is just a bullet point because it's super important. I want this to be one of the takeaways. Excuse me. So yeah, just basically keep a very close eye on these gap levels because they're going to be kind of our inflection points about whether they are gap fills or gap continuations. One little nuance that you can kind of add into this whole mix once you kind of get that stuff down are multi-touch gap fills. So a multi-touch gap fill is one that dips into the gap, reconfirms over that gap and opening level, then dips back again. And these can be really mean. They can be stop runs. They can be really like head fakey, right? But they often can provide the best risk reward opportunities. Remember we talked about how some gaps only will close 75% and then the shorts get squeezed. Well, imagine if you're the one squeezing those shorts, right? So that's not like a beginner thing. It takes a lot more nuance to kind of identify. You have to either have real conviction in the fundamental argument for the stock going up, or you have to see something else based on your other indicators or your other systems. And that's totally valid, right? This isn't one size fits all. Everybody has their own style. And what I like to do is give you more tools to add to the toolbox, right? And work into your trading style. I think that's the best way to hone your skill set as a trader in general. So keep an eye on that. And then we also have failed gap fill reversals, which is kind of what I mentioned, which is when price can't completely close the gap, they can move MOEV production value here. Sorry. They can move explosively. So yeah, just some stuff to keep in mind there for sure. And I like I said before, I'd love to see you guys try to track these performance in some quantifiable ways, because then it helps build your trading journal, and it'll let you look back and say, hey, I've made these tangible skills. I've made progress in these tangible skills. I'm actively progressing as a trader. It really just makes you feel good. And if you're not trading so hot, it gives you really actionable data to work off of and try to pinpoint what you're doing wrong. Because I mean, heck, this is a hard game. And if you're making progress, excellent. If you're not, that's okay. It just means that you're still in that learning phase. You're still paying tuition. You can stick with it. You can manage your risk. You can mitigate your risk with stuff like Trade the Pool is super great. I mean, I love these programs because essentially I don't have to risk my own money. I know some of you might have heard Michael Katz, our founder, talk about how he took a big old loss, like a $90,000 loss on some stock. And our goal is to basically, you can learn from our mistakes, right? You don't have to take that 90K loss. I've taken some substantial losses myself. And you know what? I wouldn't wish it on my worst enemy, but they did help me progress very fast because I didn't want it to happen again. So I started being diligent. I started tracking things like these, like the win rate by gap type. So you can start looking at your stocks, and you can even whip up an Excel spreadsheet and say like, okay, I'm putting in these stocks, and then you can have it automatically track what they do after. So you can look back and say, okay, in my gap fill basket, how many of these filled? Oh, look at that. They got a percentage. Oh, my gap extension plays, how many of those continued on? And so this kind of really helps take it out of this abstraction of, just concepts that I can teach you, but actually seeing it happen and seeing your own notes confirm that will be really validating and help you believe that I'm not completely full of crap, which sometimes I definitely am, but I do think this stuff is very valid. So keep an eye on the win rate by gap. Keep an eye on risk adjusted returns too. So this is getting more into like institutional analysis. So if you don't know what a Sharpe ratio is, that's okay. I could not tell you the formula now, but in general, these are just ways to measure the gains, the potential gains versus the potential drawdowns, right? So your risk versus reward. Fancy way of saying RR, so yeah, very good to check on that. You can look at time-based performance as well if you want to get even more granular and see how long these setups take to materialize or to play out. And by doing that, you can really help kind of hone in like, okay, how long do I want to hold each type of trade, based on the statistical likelihood of them playing out after 2 days, 3 days, 4 days, 5 days, that kind of thing. And what you'll see is that the longer it takes, often the less reliable they'll be. And that should show up in the statistics. So the last thing is just market condition analysis. So performance in different VIX environments is super key. You've got to adjust your trading style based on VIX regimes. So another column you can add in that Excel spreadsheet, if you're open to making one, is essentially what is VIX during this, where is VIX at during this setup? And by doing this, you'll be able to see that in low VIX regimes, you'll get a lot more continuation moves. In higher VIX regimes, you'll get a lot more gap fill moves. And then you can extrapolate that forward and go, okay, well, we're in a low VIX regime. We got like a 16 handle right now. So what setup should we be looking for most? These gap continuations. So I think that's a pretty good overview here, but what else we got here? Now I'm forgetting my last slides. So let's just talk about some quick mistakes that you can make. And by the way, guys, I do see your questions. I appreciate you all, and I will be getting to them, I promise. Just trying to power through here, through the brain fog. I'm telling you, don't get sick. It's no fun. So we have some things that are very easy to make these mistakes, and it's just better to kind of be aware of them so we can try to avoid them. The first of which being strategy mismatches. So don't use gap fill tactics on breakaway gaps. Should go without saying. Don't use breakaway gap tactics on gap fills. There's a reason why I did separate slides and separate examples for all of them, because they're completely unique situations. The only commonality is the initial gap. So that is not the key part here. The key part is what it does after the initial gap. And based on what it does, that's how we modulate our strategy. So Timing errors are another thing. It's so easy to just get in too early. Like that hymns example, if you just slammed it, right it open, you'd be down like 4 or 5% before you ever saw a turnaround. And depending on your position sizing, that could be a big deal, right? So super important to just be patient, wait for your spots, wait for your strategies to play out. And if they don't, that's okay. You just move on to the next, because remember, always more fish in the sea, right? It's like dating, basically. It's okay. It's only like dating in very specific ways, but that is one. Patience is a virtue. Know what you're looking for and don't settle for less. We're turning this into a self-help webinar. I need a little trampoline like Tony Robbins, something like that. All right, maybe next week. Anyways, position sizing. So most gap traders, they risk too much. I know, because that was me for a long time. It's just so appealing saying, oh man, we got this power mover. This is the one trade I need of the day. I'll just size up and bada bing, bada boom. I hit my target, yada, yada. Easy to say before it happens. Hard to justify when you take a big loss because you're oversized. So just risk what you're willing to risk. Everybody has their own risk management, but remember, the rule of thumb for me is never risk more than 20% of my liquidity on gap trades in general. And ideally, probably a good amount less. Like I've been doing just fine, on a 26K account right here, trading like 2,000 in liquidity or something at a time, something like that. And, just kind of scaling in and out and all of that good stuff. But in general, you don't need to risk too much if you're compounding consistent gains. Oh, thanks for bearing with me, guys. This cold's killing me. So the emotional override is really important too. So remember, just stick to the systemic rules, especially during volatility, and you're going to do great. I believe in you guys. So key takeaways here. Let's wrap this thing up. It's not just about filling the gaps. Most traders only know about the gap fills, but I said 7 here, but then I honed it down to 5. All right. more production errors. But in general, there are a lot of kinds of gaps, but they can be categorized in different ways, but they are all different and you got to approach them differently. So, gap continuations obviously provide larger profits, and gap fills will be more reliable, but more like base hits, like I've been saying. So gap size and market context are key. Remember, keep all the factors of the market in mind when you're looking at these setups in the morning, and also keep the size of the gap in mind. Bigger gaps tend to lead to more continuation moves. They're a sign of strength. Smaller gaps tend to be mean reverted. So just something to put on your radar there. I know I'm repeating stuff, but remember, it only sticks if I make it stick, right? So until you start seeing these things play out in your charts, I'm just gonna hammer you with the concepts and hopefully be slightly entertaining enough that you don't fall asleep over here. So the last thing is just gap trading. It really does require systemic classification, and it really requires systemic risk management. So that's the biggest takeaway. You got to protect yourself. You got to respect risk. You got to respect the RNG, so to speak, of the market, the randomness, the tail risks that just can occur on any given day. If any of you guys are poker players, you know about variance. You can run hot for a long time. You can run cold for a long time. All that matters is over enough hands, what are the averages of each hand, right? So it's the same way with trading. You take enough trades, then you'll see statistical edges start to emerge. So that is what I have to talk about here. I really appreciate you guys sticking with me. I see we actually have more views when we start, so that makes me feel good, guys. I appreciate you all for being here, and I'm going to start working through these questions here. So what do we got? We got a few tickers that if we have time, I will check out, but first I want to get to the actual questions. All right, we got one here. Hi, Steve. What would you say are the key differences in trading the main gap types, filling, continuation, intraday, and swing? So thank you for asking. I think that the main differences, especially between filling and continuation, are essentially the framing of it, in a sense of you're more likely to see continuation moves on stocks with fundamental changes in their story. And you're more likely to see gap fills when it is more of a positioning-based move or a smaller magnitude move. So with gap fills, you'll have lower magnitudes and you'll have a higher likelihood of filling them. And that'll be because there isn't this fundamental narrative to back up the continuation. In terms of intraday and swing, the intraday moves, the intraday gap fills are very often just going to be kind of, I always use this example, but it's like when you're using a paint roller and you go too fast in one direction and there's an air bubble. So this is kind of like filling those air bubbles and digesting the tape more completely, I guess, for the continuation of the trend, whether it is a move up or a move down. So I'd say that's kind of the differences. Hope that answers it. Let me know if I can get into any more detail for you. Bill, I hear you asking about Lulu. We'll hop on that chart after I'm done with the questions, I promise. All right. We got, oh man, tiny letters. Zen O saying, what are the biggest trading blind spots as a levels trader for you? That's a good question. Requires some introspection. Let's see. What are the biggest blind spots as a levels trader? I think one is ignoring the time component, because if you're so honed in on the levels, you can miss out on some context that you get from the time, from moves taking longer than expected to play out, or happening really fast. I think that should influence your strategy, even if you are a pure level to level trader. Because if you get a move really fast, it can often be less sustainable and need to digest further and pull back. So if I get a move really fast, I'm more prone to take profit fast and then look to add back in quicker. If the move takes a longer time to play out and has a really well-defined base and it's just starting to kind of make its move, I'm more inclined to kind of stick with the trade and make it prove myself wrong, if that makes sense. So I give more of a leniency window to trades that take that are more sustainable on their build up and their basing, if that makes sense. That's a good question, though. I'm going to think about that because I probably have some better answers, but you're making me self-reflect right now, so I don't know. I gotta I gotta think on that a little bit. Let's see. Let me check over here. We got pro tip. Don't tell people that patience is a virtue, especially if you're in customer service. Yeah, that's a tough sell for sure. But you guys, I actually do have a lot of respect for the people who come in here and are so engaged and willing to kind of engage with. I mean, this isn't like YouTube Shorts material, right? Like I'm not the most entertaining. I've really focused on getting you the information, even if it's a little bit dense. So anybody in here, I think you guys are serious about this, and I don't treat you like I would somebody at the Walmart customer service desk, because you guys have proven that you're ready for the information. So I think you guys can handle it. Wait for your spots. Patience is a virtue. I'm doubling down. So we got Robot saying, "Oh, I recognize the name. Good to see you back, man." Even an IPO would be like a gap play. Absolutely. So that would be what I would consider a well, it's interesting. You could look at it a few different ways, because you have the valuation, the initial valuation, and then often you'll see a gap from that initial valuation as price bids up. So that creates a gap that's very tradable. Definitely, yeah. I think you got a good point there. And IPOs, they're a whole different animal. If you guys like trading IPOs, I could do a whole webinar on those, because they're a lot of fun. I will give you a little free bit of alpha. Keep Webull, keep Bull on your radar. It might take a while, but I have very high conviction that will be a stock worth double, triple, quadruple what it's worth right now. Whether it takes a year, 2 years, whatever. But for the long-term port, I got a position and I'm building that up. One that I wish I built up at a similar spot in the chart was CoreWeave around 42. Just yesterday I saw what the price was doing, and I looked back in my Discord and I said, CoreWeave looks really good at 42. Classic, No, I did not take a position. I hold 0 CoreWeave, but I'm holding some Webull. So yeah, absolutely. IPOs are great. We got John McClain, the real John McClain, saying, if gaps occur intraday, do the same rules apply? Absolutely. So it can be a little different, just in terms of there often won't be news catalysts. So what I often do is I treat intraday gaps more. I'm inclined to give them the benefit of the doubt that they are gap fill plays, right? That I would like to see those gaps in the tape basically heal and basically provide a more constructive base for whichever direction it wants to go. So for example, if in the London session, you're trading at one handle, and then by New York Open, you're way up here, it logically makes a good amount of sense for the people who took that overnight trade on low volume to de-risk into the high liquidity of the New York session. And then you would be looking for buyers to step back in once it comes and heals that tape down to the London area. Does that make sense? So I think that's kind of how I would frame that for intraday. Scrolling on back here, Forex Factory also provides a good economic calendar. Good to know. Thank you for that. All righty. I think I'm mostly caught up here. Feel free to drop more questions as we go here. Got another chart request, CRCL. Oh, I hear that's a new spicy one. Yeah, we'll take a look for just a little bit because I'm probably over time here, but I have too much fun here. So if you guys are here, I'm here. Yeah, the view count's holding steady. I love it. Okay, great. What do we got? Philip saying, I often got caught in gaps which are failing. If volume is high and the gap is big, which technical parameters are leading to a gap and go? This would help me to sort out unprofitable gaps. That's a great question. Absolutely. I've been there before many times, Philip. So what I would look for are a few things. I would look for the confirmation, because volume isn't enough, because high volume without big price movement could be a sign of stalling, could be a sign of buyer exhaustion into a large seller, something like that. So what we always look for is confluence between the high volume and the price move. So when we see that volume tick up, we want to see the price candle tick up too. We want to see expansion of the actual candle as well as the volume candle, if that makes sense. So that's the biggest one for sure. The other thing is I think it's really important to have a fundamental kind of outline for the trade too. Like if it is a big gap up, then you want to really understand why it's gapping up and whether that is a valid move. Because a lot of moves, they seem valid, and then maybe the only thing I thought it was valid about it was that the price went up, right? And maybe it went up on low volume, and then you can get those gap fails. And the last thing I would say is just to be sure to respect your risk management and remember to size smaller on these gap continuations, because if they work, you don't need a big size. And if they don't work, you don't want to get hurt too bad. So I think that's how I would answer that one there. Got my boy Mike popping in with APLD has a deal with CoreWeave. Interesting. I don't know what the heck APLD is. I'm going to be completely, I've traded it, but I don't know what the heck it is. So I gotta look more into that one. Let's see. Any recommendations for good gap traders from Miji here? You mentioned SMR, OKLO, HIMS. What about UNH and a unique circumstance? Lulu and CoreWeave are interesting too. Okay. So I just mentioned those because they are recent momentum plays. You know, they've been in the past month or so, they've just gone parabolic again, you know, and they tend to provide good opportunities for gap traders like that. In general, I would say screen for high beta stocks, which is essentially a high beta stock is something that, you know, if it has a beta of 2, for every dollar SPY moves, it will roughly move twice that. Or for every percent SPY moves, it'll roughly move 2%, I should say. So by forming baskets of these, you can give yourself really you know, good pools to fish in, so to speak, if that makes sense. So that's what I recommend in that regard. Let's see, I got anything else for you there? In general, I mean, it's so hard to say, right? Because they're often catalyst driven, but in general, those high beta ones are going to get that real juice from the moves. In general, just look for leading stocks in any sector as well, because those are the ones that the market wants to reward. And those are the ones that are going to catch Wall Street offsides, essentially, right? So when the street is offsides, that's when you'll see those big gap ups in continuations. So that's definitely what you're looking for institutions to say, oh man, CoreWeave was not on my radar at 40. Now it's on my radar at 50 or whatever, and I want to send this to 100 and whatever the heck it is. I can't even look anymore. It's going to gut me, but you guys get it. You guys get it. So do I use any screeners, and how would I look for strong stocks? Great question. Great question. So, oh, awesome. Black 2 billion, 2 million, whatever that number is. Don't make me count. Good to see you in here from Discord. Appreciate that. So I would say that, yeah, you can absolutely look for screeners. So you can look for pre-market moves is the biggest thing. And then you also want to screen for volume to make sure the move is real. I don't have exact parameters for you. I do have a scanner, but I just couldn't tell you off the top of my head. But you can just Google gap up scanners. And it'll get you off on a good track there. And all right, I'll give you some secret sauce here, guys. I don't know if you know this, but I don't know everything. So what I do is I lean on the technological advancements of our time. I love just Googling around, getting a base for like a scanner, for example. I'll say, okay, top couple results. This guy scans for these parameters. This guy scans for these. I will literally just feed it into ChatGPT and say, hey, I want a scanner. I want it to do this. Here are some templates I've seen. Which of these do you like? How would you adjust these? And then I just like to play around with it. Maybe I'll try one day and one another day, ideally for like a week at a time. And I'll just compare and contrast. And I'm a big data guy. I just like seeing what the numbers will show me and working off of that. So that's the advice I can give you right now. If you send me a message on Discord, I can get you something a little more concrete probably too. Let's see. So it looks like a lot of chart questions. You are very welcome, Miji. Awesome. So I'm going to cap it here, I think, and we're going to talk about some of the charts that we had mentioned here. Oh, we got one more in here. Or is this a question? Let's see. Either way, I'm going to read it. So when running fundamental analysis on small cap stocks, how in depth would you read into any given company? How correlated are strike prices on dilution deals like warrants, ATMs, shelves with your levels? So this is where it gets a little messy, right? Because first off, when you're dealing with stocks that may be going under, things like dilution, they're affected by warrant closures and stuff like that. It's just a lot more variables, right? And then you also add to that they're very often small caps. So that means lower liquidity, bigger price moves. It is kind of like the Wild West. So I would say not to steer clear of these, but yeah, like Nygaard says, they're messy. So in general, just smaller position sizes, wider stops. When I'm trading something like this, I don't expect my levels to tag to the penny and then reverse, that kind of thing. I kind of have to expect for these wide sweeps. What you can do is you can use that knowledge to your advantage and say, hey, I don't need to buy right at my level. I bet they're going to sweep stops out, and I bet I can get a bigger deal and maybe look for some throwback to my ICT fair value gap lesson. But often you'll see, okay, you have the stock here, it gaps up, it creates a fair value gap. You can look for it to trade back into that fair value gap and push up there. So that kind of stuff there, where you can kind of, you can game the low liquidity to your favor instead of just buying at ask and then being down 3% and being like, what the heck? And then at one candle, you're down 6%. You're like, oh no, I can't get out now, because if I hit sell at ask, then I'm, taking another 2% haircut on top of that. It can snowball very easily with these low liquidity stocks. So I would recommend exercising caution. Don't treat your levels like gospel, that kind of thing. And honestly, know what you're trading. Because I'll be completely honest, I am not a small cap warrior. If it's got dilution deals and warrants that I have to deal with, that's a lot of time to invest on one stock, one trade, So very often I will lean on the people in my community that I know more than me about this, and either trust their analysis and try to back that up with what I can confirm, or I'll just trade stuff that I do know. And both are totally valid. It's totally about how you are as a trader. But that's kind of how I look at it. All right. We got some, yeah, I'm with you. It's tough with the wide spreads. And I know you're saying trade the pool, but I've traded with a lot of them. It's a very, very common thing. And it's just, it's unfortunately part of the game in a lot of ways. It depends on the data they're working off of, but most prop firms do use the same data streams we do. In that sense, what we can do and what I do to avoid this, to mitigate this, is I love my limit orders, because then I can game that same system, right? I get tagged, and then then I can catch that on the wick. So there are certain instances where you don't have a complete alignment, where you'll see a wick on your real time, like your trading view chart, your thinkorswim chart, and it doesn't quite get your order on trade the pool. But this, unfortunately, I'm pretty sure this is a technical thing that's kind of just a part of the structure that we have to operate on as a prop firm. And I'm not sure there are too many ways around that. So what we can do is just, know that it sometimes does happen, and try not to trade stocks where it can hurt us too bad. So you won't find me trading too many stocks under a couple bucks, for example, stuff like that, where it's too wide. And it's also why I use ATR very frequently to kind of gauge how big these moves are. So just something to consider. I totally hear you though. I know it's frustrating, man. I've been there myself. So Philip saying, would you say that Wall Street got caught off guard with as Zscaler reported earnings? Zscaler was up a lot, and maybe this catalyst could lead to taking profits, but ZS had a big move up. So I think Zscaler, this is a chart and a sector that I've been very, very bullish on. If anybody's been with me with my newsletter this year, we've been in Zscaler since around 210. I think 211.50 or something like that. We just really loved how giant the base was, how it was consolidating constructively while other tech stocks were either pushing up but unsustainably or getting just brutalized. They were holding up very well depending on the market conditions. That stability and that base size made me very interested. I also love the macro, the fundamental side of it too, where you get that high beta basket with the tech names, but you also essentially have the built-in buffer of if stuff gets too crazy, you're gonna need cybersecurity in terms of like geopolitical shifting and stuff like that, which we're definitely seeing a lot of this year, and I would not expect that to slow down. So the sad reality is that this world needs more cybersecurity, and these charts are set up to do that. And as we're seeing, we're getting that push. Now the question more specifically is, did they get caught off guard? I don't think so, really, in this case, just because it had been basing for so long, and there's so many kind of signs that we would need more cybersecurity. So I think they were positioned for this, and now I think we're seeing retail get the FOMO and get caught off guard, because when you have a strong push into earnings and then it still keeps pushing, often what you'll see is that this is kind of like a regime change where it's like, okay, we are done transacting at these low levels. I would be very surprised if Zscaler traded under 200 this year, for example. So in these kind of situations, I would expect the move to continue until it gets tired, probably around a previous swing high, and then I would expect some consolidation up at these higher levels, as opposed to having to retrace the gap. But we'll see. It'll absolutely be a good case study to watch. Thanks for pointing that out. My boy Time Fade saying, unfortunately, I short pump and dumps and often trade sub dollar, so it cuts into your edge tremendously. Absolutely. I totally feel you. So you are one of the cohorts of traders where that really does affect. So I'm not saying change your whole strategy, but just, it's something to consider. Maybe you can augment that with some larger cap stuff just to kind of give yourself more buffers. Because I love trading that stuff too. I'm not gonna lie. I'm one of you guys, so I will often make my safe money and then have a little bit of fun, so just some things to consider there. Nygaard and Steven, can you elaborate on what messy really is? Macro data comes in like ISM earlier this week and we're up. So I think when you're talking about data like that and reactions to data, a lot of that is positioning based. Maybe the market was expecting a lot worse. And so they're like, oh, this is nothing. This is fine. This is already priced in. So when I'm talking about messiness on a chart, I usually mean it's a low liquidity, high volatility mover. And when you have a setup like that, you'll have less reliability in your technical levels, because essentially a level may be valid, but because it's so low liquidity, they can just push it right through. Whereas if it was that level on Apple or something, there would be so many institutions and large participants waiting at that level that price would just get absorbed and there wouldn't be much overshoot. Whereas on a small cap, there can be a lot more overshoot as one big order can knife through any support until the buyer kind of re-shows its hand, if that makes sense. All right. Okay. All right. I think we covered a lot of ground here. I think this is great. Let's go over a few charts and then we'll wrap up here. Thank you so much for the questions, guys. This is fun. So give me 1 second. Bear with me while I switch to my charting. All right. So you guys should be able to see my charts. Perfect. Awesome. And let me switch for the Discord guys too. And then, I'm just realizing I forgot to check comments in Discord. So I appreciate you guys. Let me go over that real quick and see if I missed any. Black, I see you in there. I think I got to you. Awesome. Addis, Chris K, good to see you guys. Fast Eddie, my man. Appreciate it. All right. Just covering my bases there, guys. I don't want anybody to go unheard. So let me switch over on here too. There you go. All right. Charts for everybody. Charts for everybody. So let's start at the top here. We got Lululemon. Oh man, look at that gap down. That's rough. So what do we got? What do we got? So when you get a big gap like this, I think it's important to zoom out. Got the weekly here. Let's go back to the monthly. So let's start fresh here. Remove all drawings. Get rid of sidebar. There we go. Okay. What do we see? First thing that jumps out to me is these bottom wicks from the previous swing down, and they were retested here. So what I'd like to do is draw out a zone here. That is our resting support. We have, let me turn on my labels for my handy dandy indicator here, my secret sauce. There we go. So this is our quarterly support, where buyers who are primarily operating off longer terms here, like every quarter, this is where I would expect support to roughly hold. We're not seeing it hold very well. I gotta say it's a little scary when, let's go into the weekly here, when we start bumping up and trying to get over this monthly resistance and we just can't break it. Then it loses the weekly here, and now it's a big gap down. So it's a little bit scary here. I'm assuming you guys are primarily looking to buy this. What I would say right off the top of my head, this scary. That's a big old rounding pattern, right? This looks like distribution to me. And if we zoom out even more, we'll see this is where the real kind of support lies. If you look at the volume profile, I mean, this is the meat and potatoes. This is kind of just whatever, Much more shares were traded down here. I'm not super up to date on the fundamentals of the retail space right now. I couldn't tell you exactly why they dropped. What I can tell you is that I'm not ready to buy this. What I would look for if I was looking to buy this is essentially, I would like to see, so this 6-month support, this is even more valid support than the quarterly support. I would like to see this be tested and respected. So probably this is going to stair step up like this. And so at some point, I would like to see price come down and sweep out these lows, clear out those stops, and then show a willingness to be bought off of this. That makes sense. So that's kind of what I'd be looking for. But what we would be looking for is essentially a reversal of this move, which to me is saying, okay, big blow off top. We sweep down here. We get all of these stops out. Pardon me, I'm going to sneeze. Just kidding. I'm not going to sneeze. Even worse. Okay. So we push back up into this range that we've hollowed out, right? From the all-time high to the swing low where we swept these. We could not make a new high. We could not really gain much traction here. We just kind of swept up into a low liquidity space. We tagged this high liquidity node, overshot a little bit, and then rejected. We're back under moving averages. We are curling over here. To me, this looks like distribution. And what that means is that it's got a rebase. It doesn't mean that it can't go higher before it goes somewhere way down here. What it does mean is that it will have to put in a significant reversal pattern. So until I see that, it's not really on my radar, to be honest. We can look at it from a more in-depth gap perspective, and man, this just looks not good. So what we could look at is one area where it could catch is this gap fill right here. There's a possibility that it could catch here and hold. So keep 253 to 257 on your radar if you're looking to long this. But honestly, I'm not seeing anything that sparks joy here. So that's where I'm at with Lulu. But thanks for putting it on my radar. VSync mentioning one of my favorite stocks in the market that we are in as of Friday again after catching a couple of these moves. Not the whole thing, but a good amount. So if anybody knows me, I've been saying for a good year or two, ever since we got this sweep out and then pushing higher, I was like, oh, all-time highs are programmed. It's just going to happen. I have incredible conviction on this. I have a good size position. I am not sweating it because this is about as textbook as it gets for a major cup, major handle, and push above. So I am looking for big price targets above. So what I would do is I would consider this area here. Let's go. Where's the monthly high? There's a couple ways you could draw it, I suppose. In general, I see the consolidation here where it started to fall off and it lost the initial pump. I like to mark that out. Now we go back to the monthly. And we'll see that this is kind of the neckline of a giant cup and very tight handle, which is always a good sign. Very, very powerful. You saw this on like Palantir as well, or NVIDIA before it went parabolic. So Hood, amazing chart. Nothing but good things to say. We were expecting a break of this level this week. As you can see, we just tested under it barely and then surged. We're already up, what, on our position? 13%. Beautiful. And the best thing is I didn't even look at it today. I'm not even worried about it because I know where it's going. It's going up here. Maybe it shakes and bakes a little bit, but we got clear expansion. It's a beautiful chart. And what I'm looking for is a projection of the space. So I take the bottom and I'll take the, you could do it here off of this wick. You could do it off the top of this zone. It's not exact science. You know, you could even do it up here, but I think that's kind of egregious here. So what I would say is that this is probably a nested cup and handle inside of what will be eventually a larger cup and handle. So what I would expect is price to sweep highs, come back, and then make the big move. Straight vertical, just like that. So long-term targets, 100's obvious. I think 120 is very notable. I think my level on my other charts is right about here. And yeah, something around 115 to 120 is what I'm looking for here. It's a beautiful chart, amazing stock. They make money off volatility. There's going to be plenty of volatility. I love Hood. Couldn't say enough good things about it. So next up, we got PDYN. Let's take a look. Paladine. Ooh, that's a nice chart. That's a nice chart already. Thank you for putting this on my radar. So let's chart this out real quick for y'all. Got a nice flag break. I love these setups where all of the moving averages start stacking. It respects all of them and just starts to ramp. So we just punch through this key resistance. What I would be looking for is that 883 to 9 level. I'm going to draw that out for y'all. Right about there. So essentially, oh, you know what? Actually, we have this. Let me zoom in for y'all. We have an imbalance right here. Excuse me, an imbalance. An imbalance is essentially when major candles like the weekly here close with a gap in between them, right? This one closed here and this one opened here. So this provides an area of low liquidity that the tape would love to wick up to. As you can see, it smashed through it. That's a very good sign for continuation. What I would like to see is I would like to get a back test next week off of this zone and this purple monthly support here. And then I would like to see it sweep here, constructively move up, something like that. It could be a pretty explosive move, but I think that it's going to go for this weekly 200. And let's check where the daily 200 is. Beautiful. Daily 200 is rising up nicely. This is a really clean chart. And it does look explosive. This is looking like it wants to squeeze. This kind of upward consolidation like this is very, very bullish. You'll see this on names like HIMS. You see it right here, right? Very similar setup here where it's got the stacked moving averages down here. And now it's consolidating up the right wall. And then it's going to ideally surge. And then you see even here, it's consolidating upwards before it surges again. Excuse me, guys. So yeah, really good stuff there. That's on my focus list. Thank you, Tyler, for putting that on my radar. Okay. What else we got cooking here? We talked about CrowdStrike. Let's just look at that real quick. So it did kind of give the head fake of the breakout, actually, but it back tested this key level. If we look on a weekly, looks like a very constructive cup with extended handle here to me. As long as it holds 445 to 450-ish, I think this is good to keep going to 500 and then on to probably 575-ish, something like that. That's the 1.6 extension. And eventually it's going to be a $700 stock, I'm pretty sure. If If you go back even further, this is not a stock that's done. This is a stock that was way undervalued down here, and now it's going to keep on cooking. So the world needs more cybersecurity. All righty. Let's see. Did I miss any here? LVWR. Livewire. That's a move. Heck, man, I don't know what to do with this. This is some kind of, obviously some kind of catalyst. I don't know if it was earnings and this is wrong. Either earnings or they had some deal, it looks like. Watch that 630 handle. That's going to be very key. Why I say that is it's the falling monthly trigger. And for the level traders, I can just see very clearly it's a very important level, right? It was consolidating right around there. This was the swing low where it found support previously. We can use those wicks to give us a little zone. I bet if we drag it out, it'll show some response there as well. Yeah, pretty decent. That's where it slowed down before it undercut. So yeah, this is a pretty key level that I'd watch. The key thing though for me is you've got this big old volume shelf here that is now up and over. So really, as long as it holds the top of here, I think you're cooking. So $5, let's call it $5. Yeah. $5 down to even more key support at 460. So stop under 450 and you should be good to go on this bad boy. Looks kind of extended, but it looks like it's, I don't know, man, very strong. So what you could see is a rejection here. Maybe it overshoots in here and then it comes down before making its move. And it kind of forms like a little handle to this cup, you could say, or like a little right shoulder to this neckline, if you consider this a left shoulder, something like that. But I think that the market wants it up. So we'll see how far. But I mean, blue skies if you can get above here. I have no idea how this company actually works, what they do. So viewer discretion advised, I suppose. Let's see, just in case I missed anything. What are your lines called and how do you get them to stair step? Well, this is a custom indicator I use. It's a multi-time frame EMA. So essentially, there's my secret sauce. I'm giving you all the alpha. You can code this yourself on ChatGPT. Super easy. Basically just say, hey, I want an indicator that no matter what time frame I'm on, it will show a 27 moving average of the 1 minute, the 5 minute, the 30 minute, the hourly, the 1 day, the weekly. So all of these. So feel free to take a screenshot of this and make it yourself. I will not be offended. It's a really, really good indicator. I won't get into exactly why I use the 27, but people who are very, very, very smart taught this to me and it keeps on working. So I love this indicator. Go for it. We will mark the time. Oh, wow. I've been going 2 hours and 9 minutes. I got to get out of here, guys. So we're going to wrap this up in just a minute here. But if you need this stuff, it's on my screen at 2 minutes and 9, 2 minutes and 10, just about. Okie doke. What else we got? All right, guys. Nygaard's getting excited. That's a lot of messages. All right, I appreciate the excitement. What's purple line? Purple line is going to be the EMA that I just talked about. The secret sauce. All right, guys. I'm getting delusional. It's been a long week. I am sick as a dog, but I've had a lot of fun. This was good. I was not expecting to go 2 hours, but I appreciate y'all for sticking with me. It's crazy to me that everybody's still here. You guys are the best. This is why I do it. If you like this, please show some love in Discord. Give it a like, a thumbs up on YouTube. I don't know. Go tell my boss I'm great. I don't care. I'm just glad you guys are here and learning something. So thank you so much to everybody. Come back next week. And wait, we got something else here. Tim, do we have our whatever information that we want to put up for the event? Can we talk about that? Give me a holler if you're in there, and I'll just I'll double check for more questions. Did I mute you in Discord? Oh no, it says you're muted in Discord. I did not mute you in Discord. Oh, now I got to crank you up though. Yep. I can now hear you. I'm real sorry if you were talking, Tim, and sorry I've got a Tim in my ear in Discord. Right on. So you guys, we have an event coming up. Let me get you a little more information on that, Tim. If you could provide that, that would be excellent. I'm looking forward myself as well.
I'm just trying to upload the
All right, it's coming shortly. You gotta bear with me for one more second, but we got a really fun trading event coming up, where essentially it's going to be a group. It's going to be a group effort. Okay, yeah, we got the banner at the bottom there. Look at that production value. Shout outs to my man Tim. He's a lifesaver. I would be floundering without him. So check out our Discord, and we have a lot more information there. Essentially, we're going to be doing a group trading event where we're all going to be trading off one account essentially, and we're going to be trying to beat the QQQ daily market move. So if Qs are up 1%, we want to beat that. If Qs are down 1%, we're going to be green, probably, hopefully. That's the goal. But we just want to beat whatever the Qs move is. So we're going to have a lot of fun. It's going to be a real fun event. Come on in, hang out with me. I think I will be part of the hosting team that week. It's going to be a good time, guys. We had a lot of fun for the last one. I'd love to see you guys there. And yeah, I've got an image coming for you guys as well. Yeah, Tim, just drop that and I can get that up. That's cool. Thanks for bearing with me here, guys. All right. So here is our beautiful graphic here. I love our colors. It's so much fun. So yeah, one team, one account, trading competition. It'll be the 16th through the 18th. And wow, apparently $675,000 in prizes and more. One for all, guys. Let's go. Let's go. All right. So that is going to be it for me this week. I appreciate y'all so much. This was fun. This was fun, guys. I hope you had fun too. Catch me next week. We are going to be starting a whole series on essentially building a fundamental trading system for you. If you're an intermediate trader, come on in. You'll learn some stuff too. But this is something that will give even new traders a lot of stuff to work with and help jumpstart their education. So if you're just starting, perfect. If you're intermediate, come on in. I'm sure you'll learn a lot. I'm always learning from you guys too. So come on, keep coming, keep giving me more great charts, more great questions. I love it all. I'm going to let you guys go and enjoy your Friday. I hope you all have a beautiful weekend. And yeah, stay safe out there, guys. Trade safe, trade smart, and have a good one. Take care now.